Welcome to the CPA Advisory Show. I am Jeremy Wells, CPA, and with me is my co-host Chris Hervochon, CPA. We also have a special guest coming to us from across the pond today, Andrew Lynch, a CFO in industry. So we're going to dig into that, get a little bit of a different perspective on our topic here today. But first of all, Chris, first of all, good morning. And second of all, you've got some good news you want to share with us and the listeners. So I'm going to turn it over to you and let you go with that.
Sure do. Love good news. And good morning to you, Jeremy. Good morning, Andrew. We have received our first review, and it is a 5-star review. I know, fist pumping all the way somewhere with that one. And it comes from Matt 401k, and the review is great show for accountants and tax pros. Will continue listening. So big day for us. We're getting there. We're getting somewhere anyway. The first ever slow clap on the CPA Advisory Show. I love that.
Fantastic. Good deal. We're making real headway here. Our first international guest, our first review, first positive glowing review. Fantastic. All right. Thanks, Chris. Well, Andrew, without any further ado, I want to bring you on and get you introduced. So, Andrew, I came across you on Twitter probably about a month or two ago, and just started reading through some of the tweets and especially some of the threads, which I really have caught my attention and started to have a little bit of an effect on the way I'm thinking about being an accountant, running my practice, working with my clients. But you're not a firm owner, you're a CFO for a company. So first of all, tell us a little bit about that. Tell us about what you do and a little bit about how you got into that line of work. And thanks for being on the show.
Yeah, sure. Happy to, Jeremy. And thanks, Jeremy, and thanks, Chris, for having me here. I'm delighted to be here on what is a beautiful sunny afternoon here in the UK. I work for so I'm the CFO, or in UK parlance, it's a finance director. It's a smaller company of about a 15 million a year or 15 million pounds a year turnover company here. It's a third generation family business. We're a wholesaler in a very niche sector. So we sell wholesale to independent pharmacies and groups of pharmacies across the UK. So in the UK healthcare space, if you get a prescription of drugs from your doctor, your general practitioner, your GP, if they're prescribing you some painkillers or some antidepressants or whatever it might be, that prescription goes to a local independent pharmacy. So you, as the patient, trot along to that pharmacy and get that prescription fulfilled, and the pharmacist is going to put those drugs in a small little bottle, like a glass or a plastic bottle. He's going to put that bottle in a paper bag, and he's going to put a label on the bag. So we're the company that sells that pharmacy the bag and the label and the bottle. So it's the most niche, specific industry I've ever seen in my life. I'd never heard of it, never even thought about it before I started working at this company. But yeah, we turn over about 15 million a year selling bags and bottles and labels, and we are the market leader in the UK in that industry, which should give you a kind of sense of the size of that industry. It's small and niche, but pretty good. I've worked there about just over 12 months now. Prior to that, I was head of finance analytics at the UK branch of Capital One. So doing a lot of long-term P&L modelling, scenario analysis, forecasting, deep dives into whatever strategic change or regulatory change might be going on, and kind of demonstrating what impact that might have on the UK P&L. So that obviously Capital One's a huge global company that turns over about $25 billion a year, something like that. Our UK arm turned over about $800 million or so. So it's a pretty sizable business. And then before that, I was head of finance at another SMB here in the UK. They did facilities management, so a lot of outsourced cleaning, reception, maintenance services, M&E, which is like mechanical and electrical maintenance, all that kind of sweaty startup type SMB work that you hear about a lot on Twitter. And then prior to that, I've had another couple of roles as well in a startup over in Austin in the States for a year or so, and then in insurance as a graduate straight out of university. So yeah, I don't have a Big Four accounting background. I've never worked in audit or tax or assurance, thank God. I was straight into industry, straight into commercial roles, straight out of university, and been doing those ever since and thoroughly enjoyed it.
That's awesome. So you can give us a very good perspective on finance. We tend to be more in the accounting type space, and our listeners are going to be, in that same sort of space. So having that finance background and being able to tie that back to CAS, I think is a great thing. I did have one very specific question as I was kind of perusing your website in preparation for the show. But under influences, you list Tucker Max and Duvall back to
Yes.
back, and those are two of my favorites. I'm hoping that you can unpack that for us a little bit.
Yeah, sure, happy to. So I'll start with Tucker. So the startup in the US that I mentioned, that's a company that Tucker co-founded. So that's the company now known as Scribe Media. I guess when I worked there, it was called Book in a Box. So yeah, I worked for Tucker for about a year and a half in a combo of that role and doing a little bit of work for him before I started that role. But I found Tucker's website when I was probably 17 or so, like his old tuckermax.com with the kind of frat ire writing.
Mm-hmm.
And as a 17-year-old guy who just discovered things like going out and beer and talking to women, it was fantastic. And like he was this guy who was just living life on his own terms, not particularly bothered about what other people thought about him, and chasing whatever he thought was important or whatever he wanted to do, which really resonated with me at the time. And then it was fascinating for me as an outsider to kind of watch his evolution and journey from writer and author to entrepreneur. And by the time I worked for him in 2014, 2015, and I would say like the Tucker I know in person is fundamentally a different guy to the Tucker you read about in his books. Because by the time I knew him and met him, he was late 30s, early 40s with a kid, and he was married and just lived a very settled home life and thoroughly enjoyed himself. So he was a very, very different guy to what you read about in the books, but nonetheless taught me a ton about hard work, dedication, motivation, and how to be a kind of effective operator in a company. So I really learned a lot from him, if only in that 1 year working for him. But he's a great guy. I still consider him a friend to this day.
That's amazing. How about that? And then how about
Yeah.
Duvall? Duvall has a very interesting Twitter thread out there, or he's got a number of very interesting Twitter threads out there, and they've been influential to me and kind of the way that I think about the services that we deliver to our clients. Just wondering if you can kind of give us a little bit of background on that and what you found to be influential about that.
Yeah, sure. I'm assuming one of the threads you're referring to is the how to get rich without getting lucky.
That's one of them, and
Which is
there's another one where he talks about like what to study. Like one is microeconomics, the other one, stuff like that.
right, exactly. And I think kind of this links in with something I wrote on Twitter yesterday about the kind of Scott Adams skill stacking and complementary skills piece as well. So Naval's idea about learn microeconomics and game theory, or learn how to sell and how to build. That idea of building those complementary skills is something that's really resonated with me. In particular, like his most popular, I think, tweet storm on how to get rich without getting lucky. Again, was very influential on me. So things around like developing, tacit specific knowledge that people can't just pick up out of books or, learn in a university class somewhere, as well as taking on kind of personal and reputational risk and doing things under your own name, under your own personal brand, kind of develop that to generate, that economic benefit. Those kind of principles, resonate with me and have been a lot of what I've been kind of focusing on over the past couple of years or so. Hence why I'm trying to be, more active on Twitter, more active on LinkedIn, and kind of demonstrate that specific knowledge that I've learned. He's been a big influence in that part. I'm a huge fan as well of the book. I don't know if you guys read it, The Almanac of Duvall by Eric Jorgensen. So that's a great summary of all of Naval's kind of teachings and wisdom and kind of outlook on the world, which is probably my most highlighted book on Kindle.
It's a great book, and it's available for free if I'm not mistaken. And I was able to find that full list while you were talking. It's microeconomics, game theory, psychology, persuasion, ethics, mathematics, and computers.
Right, just a short list there, but if you can master all of those, you'll be good.
Yeah, you'll be
But
just fine.
he may be the only person in the world who's mastered all of those. I don't know.
So I want to dig into one of those tweets you just mentioned, though, the one about skill stacking. And as I was reading through that just the other day, it reminded me a lot of when I was teaching at university, which I taught at Texas State University for 5 years, which is just down the road from where you were at in Austin. So definitely familiar with that area. I hope you had a good time when you were for that year you spent there.
Oh,
But
fantastic.
oh yeah, it's a great little city. But it struck me as I was reading through that list. It reminded me a lot of what I was teaching to undergraduates in university, what we called soft skills, and
Right.
develop the importance of developing those soft skills and being a more well-rounded person. And regardless of whatever your technical expertise was, no matter how great you were at the technical aspects of your job, if you couldn't communicate the results well, if you couldn't get along with your coworkers and your bosses well, if you couldn't just show up and be a decent person along with being good at your job, then you were probably going to struggle, right? As opposed to someone who maybe was less technically proficient but had those soft skills well developed. So I think this is especially important for accountants because we really pride ourselves on technical work, on being able to do the math correctly and get the right results and get the tax savings or put together the financial reports just right. When did it click for you that these soft skills were important? What made that, what drove that home for you? And, how can accountants who, maybe have thought of themselves as, these very technically proficient, workers and not really thought about the soft skills, what do they need to start doing? What's the first step? If they are the type that, maybe prioritizes that technical proficiency a little bit too much compared to the soft skills.
Yeah, it's a good question. Firstly, so I completely agree that soft skills are kind of almost, well, I'd probably say more important than the technical skills, particularly if you're looking for either in industry growth and movement up the management chain, or in an advisory capacity, trying to build your firm, trying to grow, develop new clients, develop new business, hire new employees, all those kind of things. Ultimately, it's not the best accountant who can most accurately recite some esoteric part of the tax code or some accounting standard. It's the person who can empathize with their clients, deliver what they need, grow a team, manage that team, hire, recruit, retain that team, that's going to succeed. If we call success growing a team and growing a large profitable company. One thing that probably really, really clicked for me was a project I worked on at Capital One with the implementation of this new accounting standard called CECL, which stands for, I think I'm right in saying, cumulative expected credit loss. So in technical accounting terms, the way that you used to have to account for expected credit losses was to essentially build a reserve. So you would, debit your P&L, credit your balance sheet, build a liability for expected write-offs in your loan book, and you would do that based on what you expect losses to be over the coming 12 months. That was the old accounting standard. On the 31st of December 2019, so they introduced a new standard called CECL, which meant from that point onwards, you actually had to account for the total cumulative expected losses of that loan book. So not just what you expected to build over the next 12 months, but ultimately what you expected over the life of those loans, which got quite technical for a sort of revolving line of credit, like a credit card. The reason this was ultimately brought in was in reaction to the 2008 financial crisis. So it was really to force banks to actually realize and book the losses over the life of the loan immediately upon origination, rather than having a number of seemingly good years at the start of the life of that loan, and then suddenly, you start incurring all these credit losses later down the line, and your chickens come home to roost, and you have to take a huge write-off and impairment to your P&L. It was to force firms to almost take that write down at point of origination. So from an accounting point of view, it was quite technical. It got into very specific calculation methodologies around, okay, what do we decide is the life of the loan? Because this is a revolving term of credit in a credit card. How do we calculate this? How do we decide what a reasonable write-off ratio is? There's a ton of really, really technical work going on among the kind of CECL project team, on the one hand. On the other hand, you had our UK leadership team who either didn't come from an accounting background, they were credit officers, they were marketers, they were ops people, trying to understand, okay, well, I run my UK P&L here. What does this mean for me? Because I've got a budget target that I need to hit for 2019, 2020, 2021. How am I going to see this play through in my results? And the CECL project team were so in the weeds and so technical and so focused on the specific interpretation of the standard and the rollout. they were a million miles away from the UK team. So I actually made like quite a good niche for myself in being able to translate what this technical accounting standard implementation team was saying and translate that into okay, what does this mean for you as the UK CEO, the UK Chief Credit Officer, the UK Chief Analytics Officer, Chief Marketing Officer? What do you need to know? How are you going to see this play out in your monthly P&L? What do you need to be able to explain to your boss about how this is going to impact your business unit? It kind of, like at the time, I didn't really feel like I was doing anything. I'm just like, okay, I'm listening to what this guy says, and I'm telling these people over here just in slightly different language. And I did the same on some other slightly technical projects as well around kind of uh, debt sale and backbook debt sale. So we had a bunch of written off debt that we were trying to sell. It impacted how this accounting standard would come through. I won't get into the details, but ultimately, all I thought I was doing was kind of sitting in the middle of two parties and saying, "He said this. This is what you need to know." It didn't really feel that useful to me, and then at the end of the year, I got promoted, and I was like, "Oh wow, okay, people found this really really useful. I must have been doing a good job. I must have been providing a lot of value," and kind of realizing that particularly in a firm that size. But it applies to even to people doing client advisory work. Ultimately, knowing all of the technical detail and all of the answer is meaningless if it doesn't translate into actionable advice or assurance or something to your important stakeholder, whether that's your CEO, your customer, your client. Um, yeah, if you can't bridge that gap, then you could have the best technical answer in the world, but it's not going to go anywhere. It's not going to be actioned, or it's not going to be it's not going to be useful to someone. So yeah, having that experience, particularly at Capital One's, really really drove home for me that importance of soft skills.
So a lot of our listeners are going to have external clients, whereas you had internal clients in that project. How did you develop that skill set to be able to bridge that gap, or how would you suggest to our listeners a good way to develop those skills?
Yeah, it's a good question. This is where I suffer a little bit from the kind of the curse of knowledge, because I one of my somewhat natural skills is like the ability to distill a technical topic down to its core. It's something I'm not sure how I developed, frankly, but it's something I've had quite a lot of practice on. Honestly, like one good way to practice it is either through LinkedIn or through your own blog or Twitter, whatever it is. Like, try and think through these kinds of scenarios and try to say, okay, if I was sat on a bar stool next to my friend who might be a great project manager or software engineer but knows nothing about accounting or finance, like how would I explain this in very simple terms to them? Like, what's the core that's going on here? Are there any analogies I can use? Is there any way I can relate this to their situation? One guy who does this phenomenally well is Michael Lewis. So if you ever read any of Michael Lewis's books, Flash Boys, The Big Short, he has this ability to take high frequency trading or mortgage backed derivatives and explain them in really simple terms. I love an analogy he had around I think it was credit default swaps, and he just introduced this analogy of okay, don't call it a credit default swap, call it flood insurance. And when you have risky credit default swaps, what we're doing is selling flood insurance on the house at the bottom of the valley. And when you have an incredibly safe credit default swap, we're selling flood insurance on the house at the top of the hill in the middle of a desert where the highest rainfall in history is 2 millimeters. Or Goldman buying this particular derivative at a point in time is buying flood insurance on a house that's going to pay out in full if a single drop of rain hits the house at any time in the next 100 years. Using those kind of analogies, it just helps take away the complexity of the situation into terms people can understand. I appreciate that's not always possible with things like tax codes or accounting standards or things like that, but trying where you can to kind of use those kind of analogies and put them into simpler terms or distill it down into its core is incredibly useful. And one way to practice that is through writing, tweeting, blogging. putting stuff on LinkedIn or just talking to friends?
It was interesting because I had never really done any tax work before. My mentor told me to go get this license we have in the U.S. called enrolled agent. It's a license that comes from our Internal Revenue Service, right? And it allows the holder to represent clients in front of the IRS on tax matters. And so, I'm sitting here going through this study guide, and it's very technical. These are your adjustments to income. These are your deductions from income. This, and these are the credits you can get. All this different stuff. And then 4 years later, I start I'm taking the CPA exams, and one of the sections is obviously on tax, right? The regulation section includes tax, and throughout all of this learning about how the tax system works from the perspective of we're doing tax returns for our clients, right? There's virtually no education or training on how to break this down for a client, right? And so, I spent a few months studying for the exams and taking the exams and passing them, or in the case of the CPA, a year studying for the exam, passing them. But then, when it comes to clients, I spent the last 4 years just struggling to come up with, like you said, these analogies or these illustrations or these ways. And I think it's something that you just spend a career doing, right? Because, some analogies, some illustrations, some ways of breaking it down are going to work for some people, and they're not going to work for others. So like you said, these illustrations, these analogies, you just have to keep coming up with new ones. And you try one, you see if it clicks. If it doesn't, try to come up with another one. But I definitely think that's something that we as a field can do a lot better job of. We talked on this podcast about on the accounting side, there's this tendency with the monthly close, for example, to close out the books, do the reconciliations, and then send the P&L and balance sheet to the client, and then just kind of say we're done, right? That's the monthly close, we're all set, and as if the client knows what to do with those financial statements at all, right? And a lot of these small business owners we're dealing with, they've never looked at a financial statement in their life. They're not even looking at the ones we're sending them, right? And they have no training whatsoever in how to read them. So, we've been talking a lot on this podcast about building out ways of breaking down that information and making it usable, for the client, whether it's in dashboards or illustrations or better reporting or whatever. So that gets back to the role you're in. So, CFO, finance director, what is your actual role? What are you doing day to day? How are you helping the management and the leadership of your company, who we're going to assume are not accountants themselves, are not, proficient in reading financial statements? What's your day-to-day job in helping them run their companies?
Yeah, so you're absolutely right. The management are not accountants; they're not finance professionals. No one has any finance background per se. Part of my day-to-day job is, the month-end close, the bank reconciliation, producing the monthly accounts, producing budgets and forecasts, all that kind of stuff. So a big part of it is produce the monthly accounts, explain the variances to budget. Where did we go wrong? Where do we make extra money? Where do we lose money? What's that look like for the rest of the year? So, if we're over budget on headcount expense, for example, is that a temporary thing? Is that because we've got some short-term labor in to help with, vacation cover or something like that? Or is that because we've hired 3 new people who at the start of the year we didn't think were going to be here, and that's an ongoing expense? So how's that going to impact the full year turnout for the result? Then, because we're a wholesale business, all of our profit is generated by buying some product in bulk in a pack of 1,000 and breaking it down and selling in packs of 10 or packs of 5 or whatever it is. And depending on the volume of that product that we sell, by volume I mean like the number of units, not the actual physical volume, although that's also important. Ultimately that determines the profit we make. So you can think about our business is essentially this kind of space optimization problem. So if you think about like a giant warehouse unit that can only hold a certain, volume, and by volume I do mean space in 3 dimensions of goods, how do you maximize throughput of gross margin through that space? So you could think we could either sell tons and tons of tiny small items at very high margin, or if you had literally like on one extreme, one large item that could just squeeze into the warehouse and we made, £20 million profit on it. Okay, we only need to sell that one thing throughout the year in order to make the money. or we could sell tons of tiny atom-sized pieces with a penny or two margin. But if we could sell billions of them a year, you'd also do well. And obviously, the reality is that somewhere between those two. But I kind of think about it as, how do we optimize throughput of gross margin dollars through that warehouse? So that means either selling more products, changing the pricing, buying them in cheaper, maximizing throughput of items, so kind of minimizing the number of inventory days on shelf, all that kind of stuff. And then on the back end, how do we make sure that we actually collect that revenue from our clients? Because the vast majority of them are being sold on kind of net 30 or net 60 terms. So how do we get paid that money, and how do we minimize the the kind of inventory holding cost in the middle? So part of my role has been kind of analysis at a product level. So which products and which product ranges are really driving that gross margin, which they were tracking, and they've got data to support that, but kind of hadn't gone into the detail about, like, okay, we have this particular product range, for example, it generates a 15% gross margin. Okay, sounds fine. Well, it's okay, but also it sits around in our warehouse for much, much longer. We're financing that, so that comes with its own interest cost. These things are bulky and take time to pack. So although our fulfillment labor might be 5% of the cost, actually on this specific range it's more like 10%, because it just takes longer because it's a big bulky item, and because it's not selling as quickly as this other item. It costs us more in financing terms, and on top of all that, it's not a core item for our customer base, so it's more of an ancillary product. So we have this non-core, like non-strategic item that takes up a ton of space, doesn't sell that quickly. We're not getting it for a very cheap price, and the customer can get it elsewhere. Should we bother? So on things like that, we've made decisions to kind of cut certain product ranges, and as a result, we've actually been able to reduce the amount of warehouse space that we're leasing, which drives pretty significant OPEX changes. On the flip side, we have a number of products that are crucial to our customers' businesses. So they're very, very core products. They're the nuts and bolts of their business. We provide the best quality on the market. We also provide the fastest shipping times. And so the scope there to drive price increases, because our customers aren't necessarily going to go elsewhere. They value the service and the relationship they have with our company. So we can drive additional margin there straight up through price increases, or we can be buying in larger quantities than we are at the moment, because it's such a fast-selling item that hanging around on the shelves for another couple of weeks, actually, it doesn't matter, and they're not products that go obsolete. So we can drive savings on the purchasing side, so we can reduce our cost of goods, and we can increase the revenue through doing this kind of product-driven analysis. So that's one thing we've looked at. On the flip side, at a customer level, so we've looked at which customers are driving the most kind of gross margin pounds. What happens when we allocate all the fulfillment costs to that, so all our warehouse labor and shipping costs to those customers accordingly. And then we can identify customers who are on price lists that are too aggressive, for example. So a lot of our customers have differential pricing because we negotiate it on a customer by customer basis, depending on the volume that they're going to put through us. So we can look at, do we have any customers that are marginally profitable at best, or even loss making? And is there scope to negotiate those pricing, or just to say to those customers, thanks, we're going to put your prices up 20% tomorrow. If you want to go elsewhere and do business, great, like, good luck. But we're not making any money serving you at the moment, so we need to put the price up, or you need to go elsewhere. So we've been able to do things like that. And then from a kind of, I guess with my big company hat on, look at how's the company structured? Does it have clear lines of reporting everywhere? Do we have clear objectives? Do we have clear metrics and OKRs? How are we tracking the performance of this company? On what cadence are we tracking the performance? So one thing we put in is like a simple weekly management meeting. So again, we've borrowed a few ideas from the book Traction about EOS. So we've started doing weekly level 10 meetings, although we don't call it a level 10, we just call it a weekly management meeting. We've got some metrics. We've got quarterly management review meetings where we set our key priorities for the next quarter, and a KPI dashboard that we're tracking every week to try and drive the performance of our business. So it's a lot of it is the kind of nuts and bolts, blocking and tackling aspects of running a small business, but just that in a finance seat and in a CFO seat, you have the visibility across the business to be able to do that. and to be able to kind of think about the business in a very quantitative, metric-driven way, in a way that the ops director might not, because he only has access to certain data sets, or the CEO might not be able to because he only has access to certain data sets, not the financials, so on and so forth. So most of that's the kind of thing I've been working on over the past year or so.
So a lot of that is data driven, and we talked about dashboards and things like that a couple episodes ago. And that is one of the services that CPAs and accountants can offer as part of their CAS packaging that's really valuable to clients. So I'm wondering um, if you can just kind of help us unpack, what are you thinking about when you're putting together a dashboard? What is the data that you're looking for inside of an organization? How many metrics should go on there? How do you decide what the metrics should be? How do you kind of just go about that process?
Yeah, sure. So I guess we've got a couple. So we have our monthly accounts, which cover all of the kind of fairly standard finance metrics. So turnover, OPEX, gross margin, business specific ones to us. So obviously our gross margin is very important because we're a thin margin business on the gross margin level. But we also track things like fulfillment costs as a percentage of our turnover. So that's an important one for us. Inventory days, receivables days, payables days, cash on hand, stock turns for us, again, is a big one because we're an inventory driven business. So stock turns is super important. So all of those kind of relatively standard finance metrics, which we do on a monthly basis because that's the cadence at which we produce our accounts. So updating something like payables days on any more than a monthly cadence would be kind of overkill. Then on a weekly basis, we'll look at more activity-based metrics. So as an example, we look at the amount of time that our sales team has spent on the phone, because a lot of our sales efforts are done remotely. We have a telesales driven model. So a big part of us is, per person per day, how much time are they spending on the phone? That's ultimately going to drive sales and going to drive turnover in the future, we hope. So it's one thing we're looking at. Complaints is another one. Things like the abandoned call rate in our customer services team. So what's the percentage of phone calls that ultimately didn't get answered and people dropped off? Cash on hand is always one. Let's say we're a relatively thin margin business, and sometimes cash isn't a constraint. It's just something we need to be very cognizant of. So it's something we track on a weekly basis. We have about 8 or 9 metrics on our weekly metric reporting that we look at as a management team. We did have more than that, and it ultimately it got quite unwieldy. And again, it was kind of death by metrics and death by KPI. So we massively trimmed it down to about 4. And then we thought, this is too few. We need to increase it a little bit. So we've settled in at about 8 on our weekly reporting, which roughly works out to about one or 2 per department. So we have sales and gross margin. We have for our kind of sales team, we have sales is actually more of a fulfillment one because it's about fulfilling the orders rather than getting them. The way revenue recognition works in our business is that you book the revenue once the goods actually leave your warehouse rather than when the order's placed by the customer. So sales is kind of a very broad measure of how much product did the warehouse team get out the door. We have time spent on the phone for our telesales team. We have abandoned call rate for our customer service team. We have number of complaints for our ops team. Then from a finance point of view, we have overdue debt and cash balance, basically, are the weekly ones. Any more than that, and we would get pretty metric sick by the end of that meeting, because there's only so much you can really do about it. The way I kind of think about it is, if you're reporting a metric on a weekly basis, could you actually do anything to improve it by next week? If yes, cool, put it on the weekly metric sheet. If not, it's probably overkill and needs to go in a kind of monthly one or a quarterly one.
So we're looking at maybe half a dozen metrics at most, plus or minus 1, right? And are we delivering those in a visual way, or is that a spreadsheet? Like, how does that resonate across your organization for folks who aren't necessarily finance folks?
Yeah, at the moment it's an incredibly technical solution, which is me putting it into a spreadsheet and then copying and pasting it into a PowerPoint deck and then screen sharing over a Teams meeting. So that's as complex as we've got so far. A lot of our reporting is kind of disparate throughout the organization, but it's ultimately all built on query spreadsheets. So we're a little bit old fashioned in this, and one of the things I was actually doing yesterday is I've signed up to do like a Microsoft Power BI certification. So coming from Capital One, where the finance team was hugely pushing SQL and Python, so I kind of developed some SQL skills. We had a bunch of data all stored in Snowflake, so we had these like cloud data warehouses. We'd write some SQL to pull it down, ultimately, pull it into Excel and turn it into graphs there. Or a few of us started learning some Python to do some slightly more advanced or automated data manipulation. The current company that I'm working at isn't there yet, which absolutely makes sense. That's why it's a £15 million a year company, not a $25 billion a year turnover company. So we're looking at implementing something like Power BI. At the moment, the majority of our dashboards and things like that are built with query reports. So they're fairly straightforward SQL queries that dig into our database, which stores all our sales and order and product data, pulls it all out into Excel, and then puts in graphs, charts, pivot tables for people to consume that way. The most of it is done either by saving those graphs into PowerPoints and then sending them out as PDFs or just as PowerPoint decks. That's about as advanced as we've got at the moment. I think there's opportunity to, at the very least, develop more on the Power BI side and automate some that way. It's going to take a little bit of my time, but it's something I quite enjoy doing, that aspect of it. I quite enjoy getting into the technical side of it there. So that's probably going to be the best solution for us, particularly because we're already in the really into the Microsoft ecosystem. If people are using things like Xero or QuickBooks Online, there are a number of kind of MI data analytics tools that plug in quite nicely to those. There's a number of dashboarding tools that you can use just to plug straight on top or to sit nicely on top of that kind of cloud accounting platform, which can do it all there. The downside we have is that everything's self-hosted and it's on our own servers. So we're not using any cloud-based systems per se, which does limit to a certain degree the amount of kind of automated reporting we can do.
And that in our business, that's one of the or in our firm rather, that's one of the reasons why we're so big on a cloud ecosystem, is because of that data connectivity and being able to get financial data and non-financial data together. It makes everything from a BI perspective just so much easier.
Yeah, 100%. Especially if you're starting from scratch today and you're just starting up a company, there's no reason not to do that. We have a problem that I'm sure hundreds of thousands and thousands of companies do, which is everything's built on legacy systems. So we're using the same ERP and warehouse management order fulfillment system that we were using in the the late 90s. So we have to deal with, you have to take the data where it is.
Yep.
Well, and because we work with the financial data and the tools that put that financial data together, it's really easy for us to think about, well, let's just switch from your desktop-based bookkeeping software to a cloud-based, GL or something like that, right? But, what struck me was when you were listing some of those KPIs that you're looking at, that's a lot of non-financial data that would be super interesting, right? So one of those that struck me was the minutes on the phone, right? Because, if you want your salespeople making sales, right, or you want your customer service people really helping clients, especially when every time you call a customer service department today for the last 2 years, you get that, sorry, but due to, excessive calls, we can't help you right now, right? So, tracking things like that, like how responsive is your customer service department? How much effort are your salespeople having to put into closing every sale, every deal, right? Those are critical, non-financial data that 99% of the time we would just never even have access. We wouldn't even, really have a good way of thinking about that. But, I say that and I start thinking like, well, maybe there's some sort of, business phone solution out there where we could be tracking minutes per call per person or, per line or something like this, right? Where, if we had the foresight or if our clients were willing to work with us to, swap out some of these systems or something, we could show an ROI and we could start developing, some of this, especially the non-financial data. For me, the financial data are easy. If I'm doing your your books, I've got access to all the financial data I could ever use, right? It's the non-financial data for a lot of my clients where it's, some of them, I don't even know how many customers you have at any given point, right? And that would be something that would be really nice to have because, all I see are the net deposits coming in, from your Stripe account or from your sales platform or whatever, right? In the books. And so that would be really helpful, information to kind of bulk up what we're doing. So I think, part of the takeaway for me there is, if you're coming into this as a bookkeeper, as an accountant, as a CPA, spend a little less time focusing so much on the financials, right? Not that they're not important, but get creative on some of those non-financials, and don't be afraid to try to advise your clients on some of those non-financial data points if you think they would be useful, if you think they would be something that would factor into that analysis really well.
100%. Like a tangible example for the phone system one is, so we use a VoIP system called 3CX. So 3CX can do automated reporting, which I know because it automatically comes into my inbox every morning. So the system admin has set up some automated reporting for these specific individuals. That goes to someone else in our organization every day, every 24 hours. And then we've just set up a mail rule in their email box that auto forwards to me. As it is, I'm internal to the organization, but there's no reason that couldn't be a rule to auto forward to my CPA, my bookkeeper, whoever it is, on a weekly basis, a monthly basis, however you want to do it. And then straight away there's some non-financial data. Depending on what systems your clients are using, things like that, you can start looking at automation tools, things like If This Then That, or Zapier or Zapier. I think I think Zapier is the British pronunciation. So you can use something like Zapier, maybe just to take some data out of Stripe or Dropbox or Basecamp or whatever you're using to manage client projects, and just put it into a Google Sheet and then share that Google Sheet with your CPA or your bookkeeper. And then straight away, maybe there's one or two extra metrics that you can get a look at there, and things you can have access to and use that as part of your monthly reporting or your weekly reporting. There's definitely ways, like you say, you can get creative and get access to things that your client might not be willing to give you access to, like the base system, which is absolutely fine. But if there's a way to automate reporting out of that, even into something as simple as a Google Sheet, it can give you an extra level of insight into the business and help you give your client an extra level of insight into the business that they might not have at the moment.
Fantastic. That's definitely one of the takeaways for me is start trying to dig into more of that non-financial data, with my clients. Another one is something else you said about the KPIs themselves, the metrics is, as you're putting together this list of metrics, be asking yourself if within the time frame of this metric, can we actually do something about it, right? Because it's one thing to build this pretty dashboard that has all these numbers and charts popping out at you, but if you can't actually do anything about it, or if you're measuring it in a cadence where by the time that data will update, there's nothing we can really do about it within that time frame, it's really pointless. It's just a pretty picture that you're showing off with no real utility to it. And then I think for me a third takeaway is what we were talking about with the soft skills. Be developing those, be reaching out to your clients, be talking to them, be finding out, what could be helpful for them. And I think most important, what you said and what I'm trying to do more of constantly in my practice is just be writing more, be putting some of these technical concepts, this jargon, these things that are going on in my head, put them out there on your website, on your blog, on Twitter in a way that would make sense. Like you said, the guy you would sit next to at the bar that, has zero, accounting expertise and see if it works for him. How about you, Chris? Any other takeaways for you?
Mine were very similar. So soft skills being the key, and developing content in order to develop those soft skills was a really great takeaway for me. And, for our listeners, the Twitter example is a great example because it's not a super long post, or it doesn't have to be. You can do it in 5 to 10 minutes. You don't have to sit down and write this big long blog post that I know for us in our firm it's intimidating and it's time consuming and we're all busy and that whole thing. Like, you can sit down, can you and just think of things like, can you explain it on Twitter in 5 to 10 minutes in a short post? That is a great takeaway for me. And then on the data analytics piece, 6 to 8 KPIs at most, non-financial information, super important, and then cloud for connectivity. I think those are definitely my key takeaways, and I think that that's something that's going to resonate with the listeners and something that we can employ in a CAS practice to deliver really good CAS services to our clients who are not necessarily financial folks.
Fantastic, Andrew. Can't thank you enough. This has been really great for me. Like I said, reading through some of your Twitter threads kind of got the ball rolling for me on thinking about some of these things, and then hearing this conversation just even more so. So it sounds like you're doing great work. Where you're at. Please keep up the posting. Like I said, you're really helping me out thinking about some of these things. And again, thank you so much for being on the show. Chris, you want to wrap this up for us and tell people what to do?
Absolutely. So you can follow us on Twitter, CPA Advisory Show. The shows are posted on Spotify, Apple Podcasts, and they're also in video form on YouTube as well. If you like the show, or maybe if you don't, leave us a review and we will read it on the air, as we did earlier in this episode. And apart from that, Andrew, where can everybody find you?
So you could either go to andrewlynch.net, that's Lynch with a Y, and you can read up all about my influences there: Duvall, Tucker, Max, Ryan Holiday, James Altucher, and the like, as well as a few things I've written over the years, stretching back to 2008, at a rate of approximately 2 posts a year or so. So long may that trend continue. Otherwise, you can follow me on Twitter. I'm at Andrew G Lynch, AndrewGlynch. Or if you can find me on LinkedIn, go ahead. Andrew Lynch is a fairly common name, but hopefully you'll recognize me there. Twitter or my own personal website is the best place to find me. And thanks again to you guys for having me. It's been a pleasure.
Awesome. Thank you so much, Andrew. If you are a software solution provider or somebody who would get value out of sponsoring the show, we are looking for sponsors so that we can keep the show going and up and running. So please do reach out to us on Twitter if you're interested in that, at Chris Hervochon or at JWellsCFO, and we'll get you rolling there. But apart from that, this has been a great episode. Thank you so much, Andrew. Thank you so much, Jeremy, and we will see you on the next episode.